As you waken up this morning, you see geopolitics is really front and center on the Bloomberg. Every time I seem to catch up with you, you and I start the conversation with geopolitics. But it sounds as if things are beginning to heat up. Does that disconcert you in any way?
Well, geopolitics is something that all our investors focus on. And in fact, for our investors, they see this world today as more complex and difficult to understand than ever before. And so that's a factor that weighs on these markets. You talk about things like Korea, and I think obviously these missile tests are important for the geopolitical balance. But on the other hand, you wouldn't see it in, say, the Kospi Index, which has done very well this year. And I think managing this dichotomy between global events and what the markets are doing is going to continue to be an important theme for the second half of this year.
Let's pick up on some of the big themes. I know that you're quoted this morning in the story that we wrote, that the dollar's mess, the continuing mess that we have with the dollar. When you see the mess, let's say, in terms of policy implementation in the United States of America, Mark, do you think that the next move on the dollar is a continuation on the downside, unless you get something quite dramatic from the Republicans on tax reform?
Well, we see the dollar as weakening versus, say, the euro from here. I think there's a couple of factors there. First, the European economy is doing well. Despite relatively dovish comments from Mario Draghi, the euro rallied, and we expect there'll be talk of tapering as you get into the fall. And then don't forget, we've got this debt ceiling negotiation in the United States, which, the signs are that it could be rocky, like some of the other political negotiations that have gone on. And so I think for foreign investors in particular, adding those incremental investments into the United States at this time is maybe not their highest priority. And so you've got both sides, both, I think, an undervalued euro and politics on the U.S. side contributing perhaps to U.S. dollar weakness.
But still, you would concur that your overall view about global equities is that you still want to be overweight. But you say we've got to strike a balance, Mark, between fear and greed. If I look at the MSCI Asia Index, if I look at the U.S. equity market index, at some juncture, I always like to be a little bit more cautious. Maybe I should have a little bit of fear.
Yeah, and I think the markets have done extremely well in the first half of the year. You've packed a year's worth of gains into the first half, and so maybe you want to be a little more circumspect. And for us, we took off a tiny bit of risk by reducing our overweight in U.S. high yield. But at the same time, the factors that have contributed to this ongoing rally remain in place. I think, today is the 5th anniversary of Mario Draghi saying he'll do whatever it takes. And whatever it takes from central bankers continues to be such an important theme that has stabilized these markets and helped to drive them higher.
And they have driven higher, and the debate is, I suppose, and I'm interested to get your view on this. We have it all the time. You've got the Fed debating what to do next, and the probability of a rate hike is a coin toss by the end of the year. Mark, when you hear all the news flow about balance sheet reduction in the United States of America, in theory, everybody says to me that should not necessarily unseat markets. It should just run quietly in the background, kicking along with no great material impact. Do you buy that?
Well, the way you set it up, I guess I should disagree and caveat it, but I'm not a lawyer, so I'll just say it this way. I think that the central banks, particularly the Federal Reserve, has a variety of tools that they want to use to tighten. And whether they use the balance sheet or interest rates, their goals are the same. And I think they've earned a little bit of credibility. I think since Janet Yellen took over, she's earned a tremendous amount of credibility with the markets. And so the message for investors should be, do we see them markedly becoming more hawkish? And in this inflation environment, it is very difficult to see that. And so I think as long as their hand is not forced, they may move on to use different tools, and they may try to get back to normalcy, but they're doing it from the dovish side.
Yeah, they are certainly doing it from the dovish side. But to a certain extent, I'm surprised that the bond markets perhaps haven't reacted just as aggressively. We've seen some pretty big positions put on in the bond market for lower yields or higher yields. Are you surprised by sort of I mean, I think it's a moderately laissez-faire attitude of the bond market so far. Where do you see it going in the second half of the year in the U.S.?
Yeah, we see the 10-year perhaps rising to 2.5 or something like that on the back of continued economic strength. Nothing dramatic. Remember, we still have, we've had in the past 12 months, 1.8 trillion in liquidity pumped into the world by central banks. And so despite all the talk of tapering or removal of stimulus, there is still quite a lot of stimulus that is getting pumped into these markets.
Yeah, it is. It definitely is. And that takes me to the European Central Bank. I caught up with the HSBC finance director, and I said, look, you've done really well in Europe. Things are pretty strong here for you. And he said, I wouldn't call it a raging recovery in Europe, but Europe has a whole new momentum. I just had a conversation with UniCredit, the head of strategy there, and he said, look, Manus, you know, the euro, the tolerance level from the European Central Bank to allow the euro, and I'm paraphrasing here, to run hot, it's higher. So we have this currency running higher. Do you buy into that momentum, Mark?
So we think that the euro can strengthen, and we also think that European equities can continue to do well along with global equities. I think that it's a little early in the European earnings season to say that it's going fantastic. I think it's been about as expected, although expectations have been relatively high. But what I think that we like about this earnings season is you are seeing the strength in the financials, and that does bode well both for more lending and therefore more economic growth, but also the confidence that you're speaking to.
I'm just wondering, we make up phrases here, which is the Draghi two-step and doing the Macron. I mean, do you boys and girls at UBS, are you doing the Macron? Do you believe this man can deliver? I like a dance, Mark. Are you doing the Macron?
Well, I don't want to get out and dance and embarrass my family or anything like that. I think that the shift in tone and what that meant for many of our clients, that we had moved away from this kind of dreaded populism taking on a virulent and kind of mercantilist strain towards Europe moving more towards globalization, and Macron certainly points in that direction, and also that he is still talking about the kinds of reforms getting done in France that have really helped the Spanish economy recover. I think all that is a great positive.
The flow from the clients, we covered your numbers on Friday, and we saw that reawakening of the proclivity to take risk. Are you seeing a shift in terms of money more into Europe? We talk about the flow of money coming into Europe over the first 6 months, Mark. But are you seeing the clients want to take much more active positions in their European exposure?
Well, what we've seen is that throughout this year, clients have had more of a willingness to kind of take on risk after the strong equity markets last year. And I think having just gone through Asia and North America, you know, the interest for all regions is rising. And I would say actually Asia is something that people are really focused on. Maybe they don't necessarily know how to crack it, but people are looking at the kind of investments in infrastructure that are going on there, and seeing the expansion there. And I think that's an important interest. But certainly, as those investments flow in, an important part of that is going to Europe.
And you just mentioned Asia there, and naturally, you know, we've had China data this morning, which didn't really sort of move the market. It wasn't that prophetic. It was just very much more of the same. We seem to be in a comfortable spot in China. What does that data say to you today about China, and how do the clients look at it? You talk about the infrastructure as still being potentially the route to play China. Is that the chosen methodology of the clients, and how do they look at China?
Well, I think clients are looking at Asia more broadly, and some of the things that result from the China investment. You know, we do like Chinese equities. We also like Thailand as well, where they're going to start to benefit from some of that infrastructure investment. I think with China as a whole, what one data point isn't that significant, but we've come a long way with China, where we had a great fear of the FX, the foreign exchange reserves being depleted, and a rapid depreciation of the Chinese currency, to a stabilization there, and I think that's gone a long way. Now, we have seen China kind of pull back on some of its investments to kind of work to stabilize the financial system a little bit and maybe take out some of the excesses. But they've done that from a position of strength and a position of confidence about their ability to keep the economy on track as we move into the politics of the fall.